In today's video, I will show you how to cultivate a profitable trading mindset. It is an unavoidable fact that your success or failure in Forex trading will be largely determined by your mindset. In other words, if your Forex trading psychology is off, you will not make any money. Unfortunately, most traders overlook this crucial fact or are unaware of how important having the right mindset is for Forex trading success. It does not matter how good your trading strategy is if you do not have the right trading mindset, because no strategy will ever make money if it is used by a trader with the wrong psychology. Many people appear to be unaware that they are trading with a mindset that is preventing them from making money in the markets. Instead, they believe that if they just find the right indicator or system, their computer will magically start printing money. Trading success is the end result of developing good trading habits, and good trading habits are the result of having good trading psychology. Today's lesson will provide you with the knowledge you need to develop a profitable trading mindset, so watch this video carefully and do not dismiss anything, because I guarantee you that the reason you are struggling in the markets right now is because your mindset is working against you rather than for you. Now let us look at how to form a profitable trading mindset. Step 1. Set reasonable goals. The first step in developing a proper Forex trading mindset is to have realistic trading expectations. What I mean is, do not expect to quit your job and start making $1 million a year after just 2 months of trading. Live with a $4,000 account. That is not how it works, and the sooner you ground your expectations in reality, the sooner you will start making money on a consistent basis. You must accept that you cannot overtrade and overleverage your way to trading success. If you do, you may make some quick money, but you will quickly lose it all and more. Accept the truth about how much money you have in your trading account and how much you are willing to lose per trade. Here are a few more things to think about. Only trade with risk capital that is disposable. Disposable capital is money that you do not need for any life expenses, such as retirement or other long-term goals. If you do not have any disposable or risk capital, keep demo trading until you do, or stop trading altogether. But whatever you do, do not trade with money that you are going to be emotionally attached if you lose it. Always assume that you could lose any money in your account or in a trade. If you are truly okay with that, you are good to go. Just do not lie to yourself. Be comfortable with it. Trading with scared money you cannot afford to lose, will put you under a lot of emotional stress and cause you to lose money all the time. Ensure that you can still sleep at night. This relates to the previous point about available capital. The difference is that you must ask yourself before every trade if you are completely neutral or if you are willing to lose the money you are about to risk. You have taken on too much risk if you cannot sleep at night because you are worrying about your trade. Nobody can tell you how much you should risk per trade. It all depends on what you are comfortable with. If you trade 4 times a month, you can obviously risk a little more per trade than if you trade 30 times a month. It is dependent on your trading frequency, trading skills, and personal risk tolerance. Recognize that each trade is independent of the previous one. I know that many traders are unduly influenced by their previous trade. The truth is that your previous trade has absolutely nothing to do with your next trade. You must avoid becoming euphoric or overconfident following a winning trade or vengeful following a losing trade. The truth is that every trade should be viewed as another execution of your trading edge. If you just had 3 consecutive winners, you should avoid risking more than usual on your next trade, just because you are feeling very confident, and you should avoid jumping back into the market right away after a losing trade just to make up for what you lost. When you do these things, you are completely reliant on emotion rather than logic and objectivity. Do not become overly attached to your trades. If you follow the 3 points we just mentioned, you should have little chance of becoming overly attached to your trades. Do not take any trade personally. Just because you lose some few trades in a row does not mean you are a bad trader. Similarly, just because you win 3 trades in a row does not mean you are a good trader who cannot lose. You will not get too attached to your trades if you do not risk too much per trade and are not trading with money you need for other things in your life. Step 2. Recognize the value of patience. One of the most important realizations that enables a trader to turn the corner in his trading is that he does not have to trade a great number to make a decent monthly return. Consider this: most people consider a 6% annual return on a savings account to be very good, and a 12% annual return on a retirement savings is considered very good. So, why do most traders expect to achieve 100% a month or some other implausible return? What is the harm in earning 5% or 10% a month? Over the course of a year, that is still exceptional. While I cannot guarantee that you will make a specific percentage per month, if you simply understand that slower and more consistent gains are the way to long-term success in the markets, you will be far better off at the end of each trading session. Here are some other things to think about when it comes to patience. First, learn to trade on the daily charts. By first learning to trade on the daily chart time frames, you will naturally take a bigger picture approach to the markets and avoid most of the temptation to overtrade that the lower time frames induce. Beginning traders, in particular, should take their time and learn to trade off the daily charts first. Daily charts offer the most up-to-date and practical view of the market. You do not have to trade every day. Go for quality over quantity. Consider yourself a market sniper. You have to wait and wait and wait. Sometimes for days, or even a week, without trading. Then when you see a price action setup that sets off your strategy, that you are very sure, you pull the trigger with no feelings. You will always be fully prepared to lose the money you have invested. You have risked money on any single trade because you do not trade unless you are absolutely certain that your price action trading edge is present. Step 3. Plan your approach to the markets. You must have a business trading plan, a trading diary, and plan out the majority of your market actions whenever you enter. The more you plan ahead of time, the better your chances of making money in the long run. You will always analyze the market more accurately when you are not in a trade. As a result, pre-planning anything increases your chances of making money because you will be planning to work on logic rather than emotion. Have a trading plan. I know it can be tedious, and I know you may think you do not need one, but if you do not make one and use it and fine-tune it as you learn, you will begin trading on a disorganized and likely sentimental path. A trading plan does not have to be a dry and boring document. It can be innovative. Your trading strategy could include writing your own weekly analysis before each week begins, planning out what you will do and look for in the coming week. Simply make sure you have a plan of attack before engaging in any trade. Keeping a professional trading notebook is essential. You must have a track record and must record your trades in a Forex trading journal. This is an important part of developing the suitable Forex trading mindset because it provides you with a tangible report that you can look at and immediately get raw feedback on your trading performance. It will become a habit for you to keep a trade journal, and you will not want to see emotional results staring back at you in your trade journal. Eventually, you will regard your trading journal as a work of art that demonstrates your right to trade with discipline, as well as your competence to stick to your trading plan. If you intend to trade other people's money, any serious investor will want to see this. Think before you shoot, not after. All of the preceding planning and forethought is similar to thinking before shooting. We all understand that a gun is a very effective weapon, and we all know that we should think whenever we shoot one, even if we are just hunting or shooting at a gun range. Similarly, markets can be very powerful weapons in terms of making or losing money. So, you want to do a lot thinking as possible while entering a trade, because after you enter, you will naturally be more anxious, and you do not want to put yourself in a situation where you are continuously entering unfortunate trades. Even if you have losing trades. If you plan your actions before entering, you should not regret your trades. You should never regret a trade you make, because you will never trade unless you have an advantage. Step 4. Be certain of your trading advantage. Finally, if you are not sure how to trade your edge, do not begin trading with real money. You are not developing the proper trading mindset if you start trading a live account without being 100% certain of what you are looking for. Whatever your edge is, make sure you have been trading it successfully on a demo account for at least 3 months or more before going live. Do not just jump in head first unless you are completely confident in your approach. This is what the majority of traders do, and the majority of them lose money. Have complete faith in your edge. You must have complete faith in your trading strategies. That is not to say that you're naive enough to believe that every trade will win, but you are completely confident that your edge is present every time you trade. You do not jeopardize your trading edge by taking setups that appear to be almost good enough. In that case, you simply do not trade. You only trade setups that you believe have a high probability of being fully representative of your edge. As a result, you will never be afraid or concerned about any trade you enter, even if it ends in a loss. Do not gamble. There are skillful traders, but there are also market gamblers. You are a skilled trader if you consider your trading with calm and calculated thinking and wait patiently for your trading edge to appear, much like a sniper. You are a gambling addict if you simply run and gun and deviate from your trading strategy. So, do you consider yourself a Forex trader or a gambler? Your pre-planned methods and strategies provide you with a map to follow, and it is a perfectly obvious one at that. If you can overlook the emotional impulses that arise in your thoughts, you will have no trouble profiting from trading. I hope today's lesson has given you some insight into how you can develop the right mindset, ignore your emotions, and break the bad habits that are sabotaging your trading success. Thanks for watching, and do not fail to drop your comment.